I want to talk about a commodity money regime and, as I said, argue that the boom-bust scenario would not have played out that way, could not have played out that way under a commodity standard with free banking. Under that kind of regime, any incipient housing boom would have been automatically dampened well before a severe bust became inevitable. Jerry Jordan did a good job of reminding us this morning that an automatic gold standard has reliable, self-equilibrating properties that our current regime does not have. Now, I specify a commodity standard with free banking because simply saying a commodity standard, or to be more specific, a gold standard, doesn't fully enough describe the monetary regime. We have to ask who issues most of the money held by the public, which is bank-issued money or central bank-issued money. There's a big distinction there. So there are at least three varieties of gold standard that need to be distinguished. One, a gold standard with a discretionary central bank, as in the United States during the 1920s. That's the most poorly constrained kind of gold standard. The intermediate case is a gold standard with a well-behaved central bank, one that plays by the rules of the game. I'm afraid I can't provide a historical example of that. They're quite rare if you read Arthur Bloomfield's famous 1959 study. And third, the most well-constrained system is a gold standard without a central bank, but instead with free banking and a self-organized clearinghouse system. If we think about the discretionary case first and ask, could a poorly constrained central bank, even when it's officially on a gold standard, that is, a central bank that can act with discretion and isn't tightly bound by the rules of the game, could it have replicated the Federal Reserve's recent policy mistakes? And I think, unfortunately, the answer is yes. So a gold standard is not enough. During the 1920s, while it was officially on a gold standard, the Fed made very similar mistakes. It held interest rates too low for too long by creating too much credit. I skipped details about the context in which they thought that was the right policy, but as we know, the U.S. economy boomed. The real economy boomed until June 1929. It boomed in a disproportionate way with overexpansion in interest-sensitive heavy industries. Asset prices rose until October of 1929, and then the boom collapsed as it had to, although, of course, the subsequent contraction was much more severe than it needed to correct the boom. But this all happened under the Fed, not tightly constrained by the gold standard, but rather conducting an experimental dollar standard. So there's the problem that a poorly constrained central bank, even under a gold standard, can overexpand credit. But even in that case, of course, it can't keep the boom going forever. Even when there's no limit to how far the money supply can expand in nominal terms, there is a limit to how long you can fool people into thinking that investment prospects are better than they really are, or that they're wealthier than they really are. If we consider the intermediate case with a better constrained central bank on a gold standard, there's an automatic self-regulating mechanism, that is, the famous price specie flow mechanism operates on the central bank. When gold flows into the country, a well-constrained central bank allows domestic commercial bank reserves to rise, thereby allows the domestic money stock to rise, the domestic price level to rise, until gold is no longer attracted. And I leave as an exercise to the reader, substitute dollar for gold in the case of countries that are pegged to the dollar as an external standard, as George Tavlis was talking about. But even a well-intentioned central bank is, of course, fallible. And one of the problems the Fed had in the 20s was that there was a genuine opening of new investment opportunities, and as loan demand increased with new investment opportunities, instead of letting loan interest rates rise to the new equilibrium rates needed to accurately ration the limited supply of real savings, the Fed began to expand credit to keep interest rates from rising. This is a problem that the natural rate was rising and the Fed did not let the market rate rise. And of course, the Fed had no way of knowing exactly where the new natural rate was. And that's a problem generally for central banks. But a tightly constrained central bank in that kind of process will discover its mistake faster than a loosely constrained central bank. It'll end the expansion because it'll start losing gold reserves, and the expansion won't go on quite as long. So the credit booms will be shorter and the busts will be less severe. But if we really want to minimize credit-driven booms and busts, we need a tightly constrained system. And I think the best system of tight constraints is free banking, where interbank competition enforces the commitment of issuing banks to gold redeemability, and that constrains money creation. And where there's no central bank to loosen that constraint, which has been the historical tendency of central banks. So a system-wide overexpansion is hardly possible because there isn't any one bank that's supplying the fuel, that's supplying reserves to all the other banks. There's no leader in whose wake the commercial banks all follow. If we go back to the scenario of an increase in genuine investment opportunities and a strengthening of loan demand, a system of competing banks of issue won't prevent the loan interest rate from rising to the new higher equilibrium level. True, no individual bank knows where that is either, but the market will discover where that is. And the rising interest rate will curb overenthusiasm and curb asset price bubbles. Curbing asset prices will in turn avoid the phenomenon that Jerry Jordan referred to earlier as your house is your ATM. Consumers thinking that their paper wealth now makes it rational for them to stop saving and start a consumption binge. So Hayek had a name for this. He called it the interest rate brake. The interest rate brake will operate to prevent malinvestment and overconsumption in a system where interest rates are set in a market not controlled by a central bank. So banks as a whole will not be in a position to expand unless interest rates rise, and then they might expand a little because their deposits will rise, but otherwise they won't. Even then, banks won't all expand at a uniform rate, and the interbank clearing system keeps other banks in line with the most conservative banks. That nips excess expansion in the bud. Now, some critics of free banking, some advocates of central banking back in the 19th century, but this argument's been echoed in the more recently, have imagined a collusive expansion in unison by dozens of commercial banks. This scenario just doesn't make sense. If a dominant set of banks could collude, and they would want to act jointly like a monopolist, and what do we know about a monopolist? A monopolist wants to restrict output, not expand output. Restrict output in order to get monopoly prices. In banking, that would mean a bigger spread between deposit rates and loan rates, but lowering the deposit rate, which is what the cartel would want to do, means a smaller volume of intermediation, not a larger volume of intermediation. Now, there's another scenario, which is kind of like the one I spelled out of central bank trying to accommodate the demands of credit by not letting the interest rate rise. Hayek himself actually spelled out a scenario in which he thought commercial banks might do that. But I think that's implausible because for each bank there's a cost of lowering its reserve ratio, namely the bigger risk of running out of reserves. And a bank needs to be induced by a higher return if it's going to run a higher liquidity risk. And so you won't get that without the interest rate rising, and thereby nipping the expansion in the bud. If we go to the next backstop, which is the loss of gold reserves, it'll happen in a decentralized way, in a decentralized system of issue. There won't be any possible countervailing action by a central bank trying to sterilize gold flows because there won't be any central bank. But maybe the more important point is each individual issuer in a competitive system that has no privileges, that isn't in a special monopoly position, has to worry about its reputation and has to observe its contracts, right? Central banks face neither a reputational nor a legal constraint, right? They don't have any competitors to worry about, and you can't sue them. So there's very little penalty for bad behavior, which explains why Bloomfield had a hard time finding any central banks that really played by the rules of the gold standard game. When there's no penalty, then playing by the rules of the game really is a game. Whereas for commercial banks that don't have privileges, I'm assuming that there's no too big to fail doctrine, behaving prudently is a matter of life and death. Okay. In the aftermath of the crash, we've had a large amount of bailouts, but the larger amount of bailouts has has been mentioned already, didn't come from the Treasury. It came from the Federal Reserve buying bad assets and overpaying for them in order to beef up the capital positions of the banks it was purchasing them from. And we look at the expansion of the Fed's balance sheet, that's something like $1.25 trillion of bailout. Well, how much of it was overpayment, we would have to figure out, some fraction of it. So under our current discretionary fiat money regime, the Federal Reserve has carte blanche to expand its balance sheet as much as it likes. It's, of course, recently promised to expand it another 25%. And one of the simple and basic virtues of a gold standard is that even a badly managed central bank can't expand that much before the constraint of the gold standard begins to kick in. And one of the virtues of a free and robust banking system is that there's no need for quantitative easing because there's no previous boom and bust. Now, without the Fed, what would replace monetary policy? Maybe I should say a little more about what I'm assuming. Commercial banks would return to issuing all types of money, as they did before central banks nationalized that function. A commodity standard, most plausibly a gold standard, would regulate the quantity of basic money. No need for the wisdom of an open market committee, with apologies to Adam Posen. Now, no less authority than Alan Greenspan actually endorsed this idea that you don't need a central bank when you have a commodity standard. I don't know if you saw this. He went on The Daily Show to plug his book in 2007, and based on my own transcript, because I recorded it and wrote it down verbatim, Jon Stewart asked, why do we have someone adjusting rates, meaning interest rates, if we are in a free market society? Right? If you believe in other words, if you believe in free market capitalism, why should we have a central bank? And Greenspan actually looked stunned for a second and acknowledged that that is a good question. And here's his answer, Greenspan's answer. You didn't need a central bank when we were on the gold standard, which was back in the 19th century, and all the automatic things occurred because people would buy and sell gold and the market would do what the Fed does now. And then he added, to the extent that there is a central bank governing the amount of money in the system, that is not a free market. And for once, I think Greenspan was indisputably right.